home robot that can follow you around. It would navigate autonomously, like the self-driving car Apple was working on.
The real problem with Tesla is that it turns out to be a mortal car company and not an immortal tech company.
Tesla's starting to show this, that the demand response to price cuts has not been what they expected it would be.
As we were selling when it was around 400 and 350, when it's been cut in half, down 60%, is not the time to run for the hills.
All that and more, so let's get to it. Tesla stock is up in the pre-market, almost 1%, sitting at 169.60. I fully expected to see TSLA in the 150s. I suppose there is more conviction in TSLA than I thought at these levels. More than likely, I will be placing my protective put for next week, today, and should Tesla creep any higher, I will have to capture my gains on that 177.5 put. Needless to say, I will be eyeing the market very closely at the opening bell.
Apple has secret skunkworks teams investigating a push into the personal robotics field.
So, Apple abandons the car to pursue robots?
They're looking at a couple things. A few years ago, they started development of what is essentially a large iPad on a robotic arm that can move on a FaceTime call to follow a user. So let's say you and I are FaceTiming, and you have one of these devices, and I tilt my head or nod my head or some such. The display that you're seeing would nod or move around to mimic my head movements on that robotic arm. So that's one potential use case of personal robotics in the home. The other, and this is very nascent, very early, would be a home robot that can follow you around. It would navigate autonomously, like the self-driving car Apple was working on. It would have a focus on video conferencing. And there's even been discussion internally, this is a pie-in-the-sky idea. The eventual peak of robotics could be the device being able to do the dishes, clean the dishes in your sink on your behalf.
Oh, so like a humanoid robot. Apple's working on a humanoid robot? Something tells me, much like the car, they're going to be a day late and $1 short when it comes to Tesla beating them to the punch. I can't wait to see Optimus at the sink doing dishes. What Apple feels is pie in the sky. The peak of robotics. It won't be long now before Optimus is busting suds.
What really matters is that we haven't had a sell-off in so long that we've forgotten how to handle it. So tonight, let's go over the rules of the road. Yes, road rules for dealing with a sell-off. Well, what do you have to do first? You have to identify the real reasons for the decline, not the headlines. Now, we know that interest rates have gone up. We need to decide whether the move is significant. The answer to this historically is that this kind of move typically doesn't do much damage to the economy, and therefore not much to earnings, which is what we focus on in Mad Money. Tesla's numbers were weaker than expected. I mean, much weaker. 387,000 vehicles when we expected them to sell more than 457,000. That was their biggest estimate miss in 7 years, and their first year-over-year decline since 2020. Tesla's a headline grabber, though, isn't it? Always will be. But let's unpack this. We know that there's been an awkward pause in electric vehicle buying in our country. China's hurting with real price cutting in the EV market. Berlin's been disrupted by sabotage. To me, this is simply par for the electric course in terms of America. We can blame higher interest rates and weakening economy, but honestly, I think the country's turn on EVs for now. It's like everyone who wants one already has one. Tesla's simply feeling what GM and Ford were feeling, okay? The real problem with Tesla is that it turns out to be a mortal car company and not an immortal tech company.
And there you have it, folks. Jim Cramer has written off Tesla yet again. A mortal car company is all it is. Just experiencing what Ford and GM has already figured out. The only real difference is Tesla only makes electric vehicles and can't pivot to hybrids, leaving this mere mortal car company weakened compared to everybody else in the industry. I can't wait to revisit this in a couple of years.
Wall Street becoming a bit more bearish on the EV company Guggenheim and Truist both cutting their price targets this morning. Now this coming on the heels of a big first quarter of deliveries and production miss. So far this year, the stock down over 30%. Among the worst performers within the S&P. A number of reasons that Guggenheim laid out. They said that they are far more confident in negative catalysts, such as those year-over-year declines in delivery, structural risks to the China outlook, and also risks posed by the current political cycle, which I thought was interesting to bring up as well. And these two teams here, Guggenheim and Truist, far from the only ones that are raising some concerns. Dan Ives over at Wedbush was out with a note yesterday highlighting some of the concerns that he has for Tesla in the near term, and that the pressure is on Elon Musk to turn it around.
Yeah, you took Guggenheim. I'll take Truist here. They, as you were just seeing on the screen, still at a hold here, but the price target lowering from $193 to $176. They're saying that the next catalysts would be the unveiling and sale of the next-gen vehicle, the one that essentially looks like Casper the Friendly Ghost right now, just has that sheet cloth over top of it at this juncture. So we're waiting to see what that will be. Could not be, or could possibly not be, a near-term event. They go on to note as well within this. I don't know, based on what the silhouette looked like underneath of that cloak even, it seems like it might be leaning towards a Jeep-style vehicle. I don't know. I'm just throwing things out there.
What? A Jeep? That thing is going to be a hatchback, a smaller version of what the Model Y is. As for what it'll look like, who the f knows? Are we speculating what's underneath the sheet now? But I digress. What is truly important is that the street has turned more bearish, if that's even possible, on TSLA. All I have to say about that is it wouldn't be the first time that the analysts on Wall Street have ruled out Tesla.
Bear call on Tesla this morning, this time from the desk of Guggenheim. They cut Tesla's target down to 122 and reiterate a long-standing sell rating. Joining us this morning is the analyst behind that call, Guggenheim director Ron Yesikov. Ron, it's great to have you back. You're not the first to suggest that maybe yesterday's numbers were not a clearing event. Why not?
Yeah, I think when you dig through the numbers and we go through painstaking effort, I would say, to build our delivery forecast, the real implications of the downside yesterday were weak U.S. demand. Some form of supply on the Model 3, but mostly, versus our estimate at least, we believe it was Model Y demand in the U.S., where we've seen inventory build in the first quarter. And if our estimates are correct, U.S. units were down something in the range of 20 to 25% year over year. I think even if we adjust for the Model 3 changeover, which has been well discussed, I think, at this point, the implications for that look far more structural than seasonal or cyclical. In terms of the demand outlook. And then as you look to the medium term, I think beyond the first quarter, which is understandably messy at this point, structural issues in China, and then I think reason to be cynical or at least skeptical of the Model 2 and the ultimate end market viability of the Model 2.
I think he means the next generation vehicle. Forgive our bearish analysts over here at Guggenheim for not knowing that there is no such thing as a Model 2. Despite that, I'm sure his painstaking research for his delivery numbers must be accurate.
And in China, there's certainly already vehicles competing at that price point and taking considerable market share.
It's true, BYD is already in that segment, competing not with other electric vehicles per se, but with internal combustion engines. Just over a third penetration of battery electric vehicles versus the internal combustion engine. So much more of that market share to be acquired in China. The real goal is to get those individuals to no longer purchase internal combustion engines.
Tesla's starting to show this, that the demand response to price cuts has not been what they expected it would be. And the net of that is they're going to lean into advertising and accept the near-term implications of lower volumes.
Tesla's already begun targeted ads on YouTube and various other social media platforms, but I firmly believe you won't see traditional advertising like on a Monday Night Football commercial until Tesla has successfully ramped up the next generation vehicle. At that stage of the game, Tesla's total addressable market will have widened significantly, and the price point of the vehicle will be in the range that traditional advertising would typically target.
It's a full year reset of numbers and potentially 2025 as well, because they don't really have new products next year. We're about 40% below the street next year for EPS. And then if you have lower volume, you have lower cost reductions per unit. Gross margins look challenging, I think, for longer, and the free cash flow implications of negative volume growth or flat volume growth in auto are pretty unfavorable because of the way accounts payable and accounts receivable work with how Tesla pays their suppliers.
What would change your mind?
I think interest rates could help. It's certainly been talked about as a material drag on the business. I think it's more narrative than actual the sole issue. Obviously, FSD attach rates post this trial period improving could really help the story and the narrative. I think we're skeptical, and history would show that connected services in automotive tend to not be widely adopted, particularly ones that cost as much as FSD does. But that would materially change the story. I think
the remaining bulls, Ron, still say and point to the minimal degree to which the core auto business is part of their overall valuation model. I mean, they are pointing to things like energy and even long-term AI efforts. Why is that not reasonable?
I think you can underwrite these businesses with the proper discount rates, is what I would say. I mean, even Elon has said that some of these are quote-unquote moonshots. I think the problem is people tend to underwrite these with far too much certainty over the long term.
Dojo's ability to help progress FSD, that is yet to be seen. But it would appear our friend from Guggenheim is skeptical on Tesla's AI abilities at all. Acknowledges that FSD would be a game changer, but doesn't believe that Tesla can do what other auto manufacturers have tried and failed to do.
I do want to start on Tesla.
Sure.
Because we've seen the price action in Tesla, which has fallen on the back of worse than expected numbers. And I'm just so curious what you think is happening at Tesla right now, and whether, and there are some analysts out there that now have gotten bearish or starting to believe that we are at some kind of big inflection point.
Right. So I think a couple of things are going on. First, and Elon's been talking about this in the quarterly calls, the consumer is under pressure. There is, even though these economic statistics are coming out and saying everything's just fine, you listen to these company reports one by one, most of them do not sound like these economic statistics are suggesting. And I think Tesla's been telegraphing the high rates. They've been cutting prices to offset them. And they will continue to cut prices. So I think there's economic weakness. There has been a bit of a backlash, I would say, and a pause, because you do have GM and Ford saying, wait a minute, we're going to take a pause here ourselves because we can't do this profitably. By the way, that's a positive for Tesla, you know, to have the competition doing this, and Tesla's just going full steam ahead.
GM, Ford, they should be following the path of BYD, pushing Tesla for market share. Instead, they've decided to retreat. The longer their absence, the greater Tesla's grip is here in the U.S. markets.
Part of it's economic, and you can use all these other excuses, but if that is the case, what's going to happen, we believe, during the next 5 years, and you know that's our investment time horizon, we think the cost of an electric vehicle, the average electric vehicle, is going to be cut in half. And Tesla's new block manufacturing techniques and technology, along with AI, are a big part of this.
What? It's not like Tesla didn't drop these hints when they released their Master Plan Part 3, hinting at attempts of reducing the cost to produce vehicles by 50%. To the contrary of what GM and Ford might think, we're gonna pull back until these things are cheaper to build. That just doesn't happen. You've gotta work at it. There's no surprise that if Tesla does the work, they're going to reap the benefits.
How much, and you've been buying on this weakness,
well,
if you want to call it that.
So as we were selling when it was around 400 and 350, when it's been cut in half, down 60%, is not the time to run for the hills. If you believe Tesla is going to be, in this we also believe, the autonomous taxi network, certainly of the United States.
Right now, people are starting to think about Tesla again as a car company. I mean, I think that's what part of what's happened here in terms of the valuation cut. Has been people said at one point, oh, this is a tech company, right? This is an AI company. This is all sorts of things. And then there were always these bears saying, well, actually, guys, it's not that at all. It's a car company. Now, some people are saying, well, maybe it's a car company. What is it? And for the valuation to sustain itself and actually to move higher, does it have to be what you just talked about, a robo-taxi company, a AI company, and all of the above?
It epitomizes the convergence among technologies that we are seeing today. And the robo-taxi network is not an if, it's a when. It's already happening. Waymo is out there, proof of concept. So it is going to happen. And if you've tried version 12.3 FSD, you'll see that Tesla...
This is the full self-driving mode that we should say is not fully self-driving just yet.
Correct. But if you drive, if using it, you will find that it is becoming more precise, but also a little more aggressive, like a human being would be, instead of this, more cautious. Right. So I think we're getting there, yes, but it epitomizes 3 technologies: robotics. These cars are and will be robots. And of course, he's got the whole humanoid robot going as well. Energy storage. Autos in the future will be electric. We believe in 5 years, 75% to 85% of all sales will be electric. Here in the United States and around the world.
Even with the pullback that we've had in terms of EVs and the adoption.
Think about this.
Especially with the pullback. In my bear case, by 2030, I have the United States at 75% penetration for battery electric vehicles. This is inevitable, and Tesla's next generation vehicle will only cement this thesis.
Yes, because if we're right on what's going to happen to auto prices, the average EV will be in the $20,000 to $25,000 range. The average gas-powered car will be about where it is right now, or a little more.
When you have the GMs and the Fords and everybody else saying we can't even make these things profitably to begin with, let alone to do it at half the price.
And just think about this. Tesla's doing it profitably and cutting prices in the process. It's pretty phenomenal. Can I just go the convergence idea?
Yeah.
One more. Robots, energy storage, they will be electric, 75, 85% in 5 years. And then artificial intelligence. This is the biggest AI project in the world. If NVIDIA is, if its valuation is correct, this AI project has to work.
What is Tesla worth? If you were willing to sell it at $300 or $400 and you're buying it now, what is it worth in 5 years?
2,000. We're in print on that.
Easy. 2,000. Easy. And I'm here to tell you, it might be an understatement.
And think about that. It's down 60%. This reminds me very much of 2018-19. We're in a bit of a trading range, and we will be, until more and more analysts, investors understand how provocative the convergence of these 3 technologies is going to be.
The convergence of the 3 technologies that will fuel Tesla to this market cap: robotics, energy storage, and artificial intelligence. Optimus, Robotaxi, the energy side of their business. AI will be the backbone of their software as a service model for all of their revenue. Tesla is much, much more than just an automotive company. And there is a grand opportunity for those that can see that. In conclusion, Apple tossing its hat into the robot wars ring? I give this a much greater chance for Apple to see this to fruition than that Apple car. Typically a car company, not the best idea, but maybe building robots to scale could be better. Either way, it just feels like they're chasing Tesla and will never ever catch up. Much of the street has soured on Tesla. Even Jim Cramer is calling Tesla a mortal car company and nothing more. Guggenheim, Truist, they all downgrade TSLA, citing mounting automotive concerns. Whereas we have our mega bull, Cathie Wood, listing 3 technology convergences that will send Tesla to a market cap that many analysts feel to be impossible. The convergence of robotics, energy storage, and artificial intelligence will fuel Tesla to be the most valuable company in a decade's time. How long will it take for the stock market to figure this out? That's all I've got for you today. Be easy. Peace.